In financial modeling concepts, next we'll take a look at financial project evaluation functions, which is NPV and IRR. In what context we actually use these functions. Financial functions save time when the Excel user computes long and complicated formulae such as net present value, calculating depreciation and interest repayments. Normally, such calculations are attempted manually unless one takes the help of a spreadsheet program such as Excel. This is because Excel has predefined functions that helps one to calculate these financial calculations. Used in the calculation of a business case computation, these functions help the users determine a series of cash flow calculations, net present value calculations, as well as internal rate of return and payback period calculations. We'll go through each of them. Now, what is net present value? Net present value is the expected future cash flows from an investment where the investor mentions a target rate of return called cost of capital for investing capital. Typically, it is 12%. It is surely based on cost concept where the investor determines their hurdle rate, which is the amount they want to get back from the project after investing in it. Depending upon the hurdle rate, they determine whether they can invest in a particular project or have the luxury to put their money elsewhere. Normally, the accepted rule is that if the net present value is greater than 0, one may invest their money in a project. If not, they generally do not invest or may reject the project. Another question that comes up in these discussions is the fact that to what levels should the cost of capital really goes? Mostly it depends upon financial model that one may follow in any regard. Many models use a nominated amount and documents the amount to be 7 to 15%. And it all depends upon the risk inherent in a project. Normally for high risk projects, the cost of capital tends to be higher in order to cover for the extra risk taken in the case of projects. Consider the following calculations in the spreadsheet. We'll determine NPV based on an assumed cost of capital figure. So in this spreadsheet, it is 12%. Since NPV is greater than 0, the project is accepted. And NPV is found out by a simple formula, NPV B4, which is cost of capital, and then the range from B2 to F2. So this is the normal cash flow which they have experienced in 1 year from 2017 till 2021. So that value is also given to find out net present value. When the net present value is greater than 0, they normally accept the project. Now we'll take a look at what is IRR. IRR equates the present value of cash outflows and present value of cash inflows. The rule is whenever IRR is equal to or greater than the investor's rate of return, which is 12%, the investment is accepted. Otherwise, it is rejected. So in this example, we see that IRR is 119%, which is given out again by a simple formula B2 to F2. Only the range of cash flows we have to give from B2 to F2. And then there is a function IRR which computes IRR, which is internal rate of return, and gives. Here it is 119%, which is greater than 12%. So the project is accepted. Hope you understood. Thank you.